Welcome back to the deep dive. Today we're tackling what might be one of the trickiest, most agonizing questions in investing: when to sell.
It really is.
Yeah, it feels like such a gamble sometimes, doesn't it? You're trying to, time it perfectly, hit that peak, or maybe dodge a crash.
Absolutely. And most people, well, they just guess.
Yeah, which can really make or break your returns.
Yeah.
But what if the secret to selling wisely isn't about perfect timing at all? What if it's something else, maybe even a bit counterintuitive?
Well, that's exactly what we want to explore today. Our mission really is to give you a shortcut to being, well, better informed on this really critical decision.
Okay.
And we'll be pulling in some surprising facts and definitely timeless wisdom from two real heavyweights in finance.
Titans, really.
Yeah, exactly. Benjamin Graham. Most people know him as the father of value investing, author of The Intelligent Investor.
And security analysis, yeah.
Right. And John C. Bogle, the visionary founder of Vanguard, his book Common Sense on Mutual Funds is a classic.
And it's interesting because their approaches, on the surface, they might seem pretty different.
Can, yeah.
But I think listeners will see pretty quickly there's this powerful unifying message that comes through about the art, or maybe it's the science, of knowing when to let go of an investment.
hmm And it's fascinating how often this hardest question, when to sell, actually has a surprisingly simple answer. Maybe not easy, but simple.
Simple but counterintuitive, like you said, because both Graham and Bogle, they really challenge the impulses, the gut feelings we often get as investors.
Right, the urge to react.
Exactly. So as we dive in, you'll probably find that selling wisely often means doing the opposite of what the market or maybe your own emotions seem to be telling you to do.
Okay, so let's get practical. What does this actually mean for you, the listener, the intelligent investor trying to figure this out? When do you sell?
Well, the first big takeaway seems to be that the sell decision. It's not really about hitting some magic number on a stock chart or timing the absolute peak of the market.
No, it's much more about sticking to fundamental principles. Principles that protect your capital first and then aim to maximize those long-term gains.
And a huge part of that, based on what both Bogle and Graham said, is steering clear of, well, short-term thinking, speculation,
Yeah.
trying to time the market.
That's a big one. It's so easy to say, don't chase hot stocks or don't panic sell, but actually doing it, that's tough.
It really is. And Bogle's data on this is just striking. How much investor behavior has changed, how short-term it's become.
Oh, absolutely. His research, it starkly shows this pattern. He called it consistently counterproductive investment patterns. Investors just rapidly turning over their mutual funds.
How rapidly are we talking?
Well, think about this. Back in the 60s and 70s, the typical holding period for a mutual fund was around 12 and a half years.
12 and a half years. Okay.
Yeah. More recently, it shrunk to just over 3 years.
Wow. From 12 down to 3. That is a massive shift. And is that just individual investors getting antsy, or are the fund managers involved too?
Well, the managers are definitely part of it. Bogle pointed to their own rapid-fire trading. The average annual turnover for fund managers was around 85%.
85% turnover. So they're holding stocks for what, like a little over a year on average?
Exactly. Barely a year. And Graham, way back, he warned about this too. He had that great phrase, cautioning against trading as if your underpants are on fire.
That definitely paints a picture, that kind of impulsive, panicky trading.
It does. And he also warned against, trendy formulas like the January effect, this idea that stocks always go up in January.
Right, those kinds of rules of thumb that aren't really rules.
Exactly. His core advice, and it still holds up, was never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop.
Simple advice, but
Yeah.
so hard to follow when things are volatile. And okay, so resisting the urge to trade constantly is key. But Bogle also mentioned the costs, right? That there's a real financial penalty for all this churning.
Oh, absolutely. Beyond just potentially missing out on long-term growth, there are these, as he put it, enormous portfolio transaction costs and staggering tax costs.
Right. And this is where it gets really interesting and maybe a bit scary, this sort of silent erosion of returns.
Yes, the tyranny of compounding costs, as Bogle called it. He hammered home that costs matter. Even small differences in fees, compounded year after year, lead to, well, staggering differences in capital accumulation.
Can you give us a sense of those differences? Like, what kind of costs are we talking about?
Sure. So think about expense ratios. A low-cost index fund might average, say, 0.2% a year.
Okay, pretty low.
Yeah. But the average actively managed equity fund,
Hmm.
more like 1.5%. and some high-cost funds can hit 2.2% or even more.
Okay, so that's a big difference already, but you mentioned hidden costs too.
Right, those visible fees are just part of it. Because of all that high turnover we talked about, the rapid trading, actively managed funds rack up hidden transaction costs, brokerage fees, bid-ask spreads.
Stuff you don't see on the statement easily.
Exactly. And that can easily add another 0.5% to 1.0%, maybe even more, per year.
Wow, so if you add it all up,
You could be looking at what Bogle called an aggregate fiscal drag, the total drain on your returns of more than 3% per year for an average active fund.
3%. If the market returns, say, 10% in a year, you're losing almost a third of it right off the top to costs.
That's precisely. And then there's taxes. Actively managed funds, because they sell stocks frequently, tend to trigger capital gains taxes much more often. They're generally tax inefficient.
Whereas index funds, which trade less, are usually more tax efficient.
Correct. And Bogle did the math on this. He showed that the combination of all these expenses and taxes could mean you end up accumulating only, say, 37% of what you might have projected over 25 years.
Only 37%.
Yeah. And over 40 years, it could drop to just 23%.
Oof. That really makes you stop and think. Like you said, why would you willingly just pay away that much of your potential return?
It's the crucial question. Are you investing, or are you speculating and letting costs eat your lunch?
Right. Okay, so avoiding short-termism and minimizing costs are huge. But what about the market itself? You know, the crazy swings. How did Graham and Bogle suggest we handle those? Or maybe ignore them?
Ah, yes. The market's moods. Graham had that famous analogy.
The pendulum.
Exactly. The market as a pendulum that forever swings between unsustainable optimism and unjustified pessimism.
Love that description. So true.
And his advice: the intelligent investor is a realist who sells to optimists and buys from pessimists.
Okay, so that sounds like maybe his most direct selling guideline, right? When the optimists, driven by, irrational exuberance, push a stock price way, way above its actual underlying value.
That's your signal. That's
Right.
potentially time to sell. He also said that market quotations are there for your convenience, either to be taken advantage of or to be ignored.
Not as orders to buy or sell just because the price moved.
Precisely. Don't let the market dictate your emotions or actions. Use its prices when they offer an opportunity. Ignore them otherwise.
And that idea, using prices conveniently, not being ruled by them, that seems to fit perfectly with Bogle's concept, too. The reversion to the mean.
Yes. He called it an eternal force of gravity in financial markets.
Meaning what goes way up must eventually, well, maybe not come down, but moderate.
Kind of. It means that extremes in performance, whether really good or really bad, tend to get pulled back toward the long-term average over time. It's a very powerful tendency.
And he had evidence for this, right? It wasn't just a theory.
Oh, tons of evidence. He stated very clearly, there's no evidence, none, that superior past performance is predictive of future success. Chasing yesterday's winners is usually a losing game.
Can you give an example?
Sure. He often cited the Legg Mason Value Trust. Amazing fund. It outperformed the S&P 500 for 15 years straight. Incredible run.
15 years. People must have thought they found the Holy Grail.
You'd think so. But in the very next 3 years, it fell behind the S&P 500 by a staggering 43 percentage points.
Wow. Talk about reversion to the mean. Gravity pulling it back down.
Exactly. So the clear message is, don't chase those star funds based on recent hot performance, and definitely don't panic and sell everything just because the market takes a dip.
Focus on the underlying value, the long-term trend, and accept that even the mutual fund champions, as Bogle put it, come down to earth with remarkable consistency.
Right. Which brings us really to the ultimate takeaway from both of these giants:
Which is?
simplicity. Bogle called it one of the most important secrets of investment success. Just keep it simple.
How simple.
His advice was basically follow a simple plan and let the cycles of the market take their course. Don't overcomplicate things. He stressed that time is your friend in investing and compound interest is a miracle. You just need to let them work.
And Graham seemed to echo that, didn't he, with his focus on protection.
Yes. Protection from overpaying for a stock in the first place, and protection from overconfidence in the quality of their own judgment. Humility, really.
Yeah. So it boils down to having a clear strategy, minimizing costs, staying disciplined, and being realistic about market swings and your own ability to predict them.
That's a great summary. It's about that steady hand, trusting the long game, not getting caught up in the daily noise.
Okay, so let's try to wrap this up for everyone listening. Thinking about this really tough question, when to sell. It seems the answer isn't some secret timing formula.
No, definitely not. It's about sticking to those core principles we've discussed. Principles designed to protect your capital and let compounding work for you over the long run.
And the big warning, the consistent message from both Bogle and Graham is avoid that trap of short-term speculation. Don't try to time the market.
Because that behavior, as we saw, just burdens you with those huge transaction costs, those staggering tax costs.
Yeah.
You really have to ask yourself, am I investing here or am I just gambling?
Yeah. And then there's the tyranny of those compounding costs.
Yeah.
It's easy to ignore small percentages, but Bogle showed how they just eat away at your returns over time.
Right. That potential aggregate fiscal drag, over 3% a year for the average active fund, plus the tax inefficiency, it adds up incredibly fast. His analysis showing you might only keep 37% or even just 23% of your potential gains over decades.
It's a powerful reason to question why you'd pay those costs, why give away your returns.
Exactly.
And finally, understanding the market's nature. Graham's pendulum swinging from irrational optimism to unjustified pessimism. His guideline, be the realist. Sell to the optimists when prices get crazy high relative to value.
And that connects directly to Bogle's reversion to the mean. Don't chase the high flyers. Don't panic, sell the dips. Recognize that extremes tend to correct. Focus on value. Stay patient.
Because even the champions eventually come back to earth.
They almost always do.
Yeah.
Which leads back to that core idea. Simplicity. Keep the plan simple. Let time and compounding do their magic.
As Bogle said, time is your friend. And Graham focused on protection from overpaying, from overconfidence.
Right. So when you're wrestling with when to sell, maybe the most profound insight here is that often the best action is inaction.
Resisting the urge to constantly fiddle, to react to the noise.
Yeah. Is your focus truly on patiently harvesting that miracle of compounding through a simple, low-cost, long-term plan? Or is it on trying to navigate the impossible task of predicting short-term market swings?
That's the question to ponder. And for you listening, what really stands out as the biggest lesson here in avoiding those pitfalls of frequent trading and high costs? Something to think about.